Well, sentiment-wise, it's all fairly familiar terrain. Consumer sentiment continues to be dominated by this cost of living crisis now, where we've seen some slight improvement around assessments of family finances, particularly around the stage 3 tax cuts rolling out. This has been essentially nullified by rising concerns that persistently high inflation may mean the RBA has to raise rates further to bring it fully under control. We've been stuck in this situation for the best part of 2 years now, slightly over 2 years. It marks the longest sentiment slumps outside of the early 90s recession. And while there are some hints of improvement, it looks like we'll need to see some further developments before sentiment can sort of truly recover. A lot clearly hinges on the path of inflation and interest rates from here. And on this front, the June quarter CPI will be an important update for the public at large and also for the RBA. We think consumer fears around inflation and interest rates are a little bit overdone. 60% of consumers expect mortgage interest rates to be higher in the next 12 months. The median expectation is consistent with 2 25 basis point rate hikes between now and then. We expect interest rates to instead start to move lower as we move into 2025. That inflation update will be decisive on that front. We think it'll be something that will give a little comfort to consumers, and as we move forward, sentiment should recover as some of these threats around inflation and interest rates start to subside. The June quarter CPI update and the RBA's response should go some way towards easing these concerns for the consumer and pave the way for some recovery in sentiment, but it'll be some time yet before we move out of this protracted period of very weak sentiment in the low 80s as at July. The 2-year cost of living siege for consumers is only just ending very slowly. So in this edition we look at 3 areas of the consumer in a bit more detail. So firstly we do a deep dive into spending patterns across detailed segments by states. Secondly, we take a closer look at the tax cut boost to activity, in particular looking at what the Westpac Card Tracker information for the first few weeks of July is telling us. And finally we take a look at household wealth and how that may be playing into more resilient spending activity in particular areas of consumer demand at the moment. In terms of the detailed spending patterns, these reveal some really interesting themes at a more granular level. We're looking at 25 spending segments across the 6 major states, and where we see hotspots, these look to be at least partly a catch-up story. Vehicle spending, accommodation and recreational services are 3 key areas that are hotspots across all states. And all of these are still recovering from COVID and post-COVID disruptions. So that looks to be partly a transitory phenomenon. Where we're seeing weak spots, they're tending to be around household goods. And in the contrast between where things are strong and when things are hot, also quite interesting. If we look at discretionary services, for example, it's been a little bit firmer in South Australia, Western Australia and Tasmania, a little bit softer in New South Wales, Victoria and Queensland. But when we compare spending activity alongside price performance, there looks to be no real differences in terms of price activity. And what that's sort of telling us is there doesn't look to be demand-driven price pressures emanating from the discretionary services segments. In contrast, when we look at the soft spots around household goods spending, there does look to be a pattern where the stronger the price rise has been, the weaker the demand side has been. So in terms of clues around how the consumer is maybe driving demand, maybe driving price pressures, it looks to be pretty limited. Instead, where they are responding to price pressures, it seems to be the usual way through curtailing demand outside of those segments where there looks to be some catch-up spending going on. In terms of the tax cut piece, we revisit some additional survey questions we ran back in May asking people about their intentions when the stage 3 tax cuts roll out. Most consumers were looking to save the bulk of those tax cuts, about 80 cents in the dollar at the time. And for what we have to date, the first 3 weeks of July from our Westpac Card Tracker suggests there's been very little bump in terms of spending activity. Now, first 3 weeks is only just the very start of the tax cuts going live. Maybe about half of employees would have received some cash in hand as a result of the tax cuts. But certainly to date, there looks to be very little shift in the dial in terms of card activity. And finally, around wealth effects, this one's an interesting one. That while we have seen some improvement in household wealth in aggregate, rising house prices tends to do that. We're still at quite a soft starting point. When we adjust for population growth and for inflation, real household wealth is still 6% below its previous peak. So to the extent that we're getting a sort of recovery gaining traction, it's probably a little premature to be expecting that to flow through to widespread wealth effects on spending, but it may be impacting spending in some particular subsegments where there's more of a wealth gain going on and people are more prepared to spend some of those gains. So all up, sentiment-wise, it's a very familiar situation. Not much has changed now since the start of the year. Still this cost of living lockdown on sentiment, concerns about persistently high inflation and high interest rates. It's not deteriorating further from its weak starting point, but any sort of recovery still looks to be a way off and will really hinge on if and when we start to get some better news on inflation that takes some of these concerns about potential rate rises out of the picture.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.